Welcome to your Money Monday.
What are the triggers of this recession in stock market volatility? And is housing aligned with this? Hey, I'm Rich Motts. Welcome to Money Monday, session 167. So recession, that's a big, scary, dark word, without a doubt. And your consumers might be freaking out a little bit. They might be saying, whoa, I don't want to buy or sell right now. And they're going to step back a few months or wait and see what happens and blah, blah, blah. Do not let that overtake you, because the opportunities are too big right now for this to overshadow your business. So let's take a look at this. We guessed about 6 months ago, there's a survey done, okay? And it was in the light blue here is Wall Street Journal, in the medium blue is Pulsenomics, and in the dark blue is Duke, the survey of CFOs, and in the light gray is the National Association of Business Economic Members. So take a look at all those guesses of when the recession was going to begin. Basically, as you can see, for 2019 right here, that Duke was putting their economic specialists, and they were actually looking at 47%. They put, most of them guessed that in 2019 it was going to happen. And everyone else pretty much was guessing, I believe, in early 2020 it was going to happen. The Wall Street Journal and Pulsenomics was really guessing. And even, the National Association of Business Economics members, they were guessing in 2020 it's going to happen. But Duke really nailed it, and it's happening in the last quarter of 2019 here is when the recession started. So we knew it was coming. It's not a big surprise to us. I just want you to remember, recession does not equal housing crisis, okay? Basically, the definition of recession, you got to remember this and know this. What is a recession? Okay, it's a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in 2 successive quarters, okay? And GDP is gross domestic product. The top 3 triggers for this recession are trade policy, stock market correction, and geopolitical crisis. Coming in at number 9 is a housing slowdown, not a housing crash, housing slowdown. Let's take a look at these numbers of where number 9 falls for this. So the top 3 triggers for recession, again, if we put them on a point system, it shows that monetary policy was the highest thing, 137 points. Number 2, trade policy was 71 points. Number 3, stock market correction was 69 points. Coming in number 9, housing market crisis, no crisis, 17 points is where we're at. So it's going to be a housing market slowdown, not a crisis. So show people this chart right here, that in the last recession, prices dropped 20%, 19.7%, near 20%. That's crazy. But if we look at the 4 previous recessions, 3 out of 4 times, prices actually went up. 2 of those 3 times, it went up almost double the normal historical average appreciation. And the other time that it dropped less than 2%, as you can see right here. So, this is not fueled by housing like it was in 2008. 2008 was a mortgage crisis. Right now, we're going to take a look at appreciation and talk about it more. So appreciation by over 100 of the top economists in the United States took a look at what appreciation is going to do. So from 2019 through 2023, and this is the same people we surveyed, what's going on with the economy right now, okay? So this is very important. So we're looking at normal appreciation. Normal appreciation is about 3% where we want to be. We have been in abnormal appreciation, and many of us have been like 6 to 8, 10% appreciation, which we're still catching up from the default back a few years ago. But this right here, great normal appreciation. So you're going to hear a lot of news saying, oh boy, housing prices, are on a decline, and they make it sound like that. But what's really happening is appreciation isn't going wham, crazy. It's being normal, and a good and healthy normal, and that's a great thing. So between 2019 and 2023, you can see normal appreciation between 2.5% to 4%. So around 3% is perfect. Bam, we're there, folks. So don't, freak out. Morgan Housel says, an interesting thing is widespread assumption that the next recession will be as bad as 2008. That's natural to think that way, but statistically, as we just reviewed there, it's highly unlikely. It could be over before you even realize it begun. So that's a great quote right there to take a look at too, and put in your slides and talk to people about. Let's take a look at what happened in 2008. Look at that huge housing bubble that happened. And then the red bar is the normal standard, and then the dark blue at the bottom is the current level, and the light blue in between is undeserved mortgage need. So the current level is way, way below the normal standard, so we are nowhere near that huge housing bubble that affected 2008. So you can clearly show consumers this and they go, I get it, man, we're nowhere near that, we're safe. So that's a great slide to show. And this even shows it even more up to date that we're still well below that level. So looking back in that 2008 period, look at this giant bubble right here. These are the people with new foreclosures, and this is what caused that 2008 housing crisis recession. So that's the big difference. Look at the number of consumers with new foreclosures, that giant spike there in the middle. That's what was going on. Look at where we are now, lowest than ever in foreclosures. Safe. We're looking great, aren't we? Here's today's, looking at the distressed properties in today's market at where we were back in 2012 when we were at its highest, and look at now, we barely have any distressed properties whatsoever. So there's another indicator to show that safe. We're doing pretty good. Mortgage rates. Look at where mortgage rates are right now. They're excellent. So we're in really good shape. Mortgage rate projections through 2020 are saying pretty stable level, like 3.8%. through 2020, the second quarter. So, and this is coming from Freddie Mac, Fannie Mae, the Mortgage Bankers Association, and the National Association of Realtors. Here's what Freddie Mac is actually saying right here as far as interest rates, what's going to happen. Looking pretty good. They're going to tick up just a little bit in 2020. And here's also another look at how Freddie Mac is saying that they're going to be so in the high threes, low fours, we should be sitting. Great interest rates, historically great. So do not freak out about what is going on in the market. Utilize these slides and tell people the difference about the recession in 2008 and today's recession, okay? That's it, folks. I'm Rich Motts, and that's Money Monday for you. I will see you next Money Monday. Remember, take action on this stuff and utilize all these slides and information to be the knowledge realtor. Okay? Talk to you real soon. Bye-bye.